Gold and silver, the world's oldest money. But today, their prices are increasingly shaped not by physical metal, but by software, data centers, and opaque trading systems. So what happens when the world's largest futures exchange, CME Group, suddenly goes offline, right as metal prices start breaking out? On November 28, 2025, the CME Group, operator of the world's most critical futures markets, suffered a massive outage. Officially, the cause was a cooling system failure at a Chicago data center. Trading halted, Globex went dark, and for hours, global price discovery stood still. But this outage didn't happen during a quiet moment. It struck during surging demand for physical silver and gold. And that's where suspicion began. Precious metals markets operate on a unique foundation: paper contracts, not physical metal. For every physical ounce of gold or silver, there may be 100 to 300 paper ounces traded in futures and unallocated spot accounts. So when investors suddenly want real metal, not paper, the system strains. Future sellers, often big institutions, face delivery risk, and any technical outage begins to look convenient. A legitimate failure can still create major opportunity for players under pressure. To be clear, there is no confirmed evidence that CME or LBMA deliberately manipulate bullion prices. But experts agree, the structure of electronic markets creates theoretical vulnerabilities. Latency-based advantages. Systems could, in theory, slow certain orders, prioritize specific firms, or limit visibility of deep buy pressure. Quote throttling. By altering, quote speed, tick size, or circuit breaker thresholds, algorithms could blunt an aggressive rally. Order flow steering. Routing logic may influence which liquidity providers see which orders. These potential methods don't prove manipulation, but they do show how complex and opaque modern market microstructure has become. Many in the metals community believe price suppression is real, not because exchanges are proven guilty, but because of three undeniable patterns. 1. Proven manipulation by major banks. Large financial institutions, including traders at major banks, have been fined for metals market manipulation schemes like spoofing. If banks have manipulated prices before, could exchanges unintentionally enable it? 1. Massive concentrated short positions. A small number of institutions routinely hold huge short positions in silver futures. These positions benefit when prices stay low. 1. Suspicious timing of glitches. The CME outage hit during thin holiday liquidity, record physical shortages, and accelerating upward price momentum. Even if accidental, the timing fuels suspicion. LBMA's system of unallocated metal, where customers own a claim, not a specific bar, has long been criticized for lack of transparency. Concerns include vault inventories that are not regularly audited, unknown ratios of claims to actual bars, and the risk that unallocated supply keeps spot prices artificially low. If physical metal is scarce, keeping prices suppressed becomes strategically useful, especially for institutions rolling large short positions. Again, these are structural concerns, not proven wrongdoing, but opacity invites suspicion. Here's the critical question. Are LBMA or CME purposely pressing bullion prices down? The truth: there is no verified evidence of intentional suppression by either exchange. But the market design allows for the possibility, especially without independent audits. Hypothetical motivations include slowing price spikes when delivery metal is short, preventing market chaos, controlling contract rollover.
Magi Metals.